I'm going to go into depreciation now. So depreciation, we want to measure how we have been using the asset, the wear and tear of long-term assets, and specifically tangible assets. So here we want to allocate plant assets cost based on its useful life and based on how we have been using the asset. So there are three main methods of depreciation. We have readily talked about straight line earlier in the first 4 chapters. Straight line, basically, we just spread it along the years. We have an equal depreciation expense every single season. So there's no difference if you compare across the years. Other types we may be based on, for example, how many miles has been used in a vehicle, okay, or how many miles have been used in other types of, let's say, plane, different types of transportation plant assets, or how many hours the machine has been used. So that's another type of depreciation method called units of production. So basically that idea is that the more we use, the more we'll be depreciating the asset. Okay. So the idea of depreciation here, just a reminder here, I mentioned this briefly in the first 4 chapters. This is measurement. It's an estimation of how we use assets. It's not a type of, it doesn't involve cash at all, because this is just an estimation of depreciation, how we use long-term assets. We're not really trading it yet. Okay, so once you purchase in an equipment, let's say $10,000, if you estimate the lifetime is 5 years, then you divide it by 5, and then every single year you depreciate the asset by that value. Okay, now here's another example. Let's say we use straight line depreciation for the truck. Originally we purchased it at $40,000. This is the price that we paid out to the seller. And let's say the estimated useful lifetime is 5 years. Then every single year we'll be depreciating $8,000, consider it as depreciation expense, and at the same time credit accumulated depreciation. Okay, so remember the depreciation entry: debit depreciation expense, credit accumulated depreciation. So what is this account here? Which financial statement does it fall under, accumulated depreciation? Remember which financial statement does it fall under? Asset. Asset, and specifically, well, asset is the category, and asset falls under balance sheet, right? So you have balance sheet, left side asset. You have, first of all, whatever the plant asset is, equipment, machinery, and then you have a contra asset account, accumulated depreciation, right? Remember, contra asset is the opposite direction of regular asset account. So this accumulated depreciation has a normal balance under the right side. It's a contra asset account. It goes under whatever the original asset was. It could be equipment, it could be machinery, any of the 4 categories besides land. So you have the original purchase price. This example here, if it's $40,000, after a year of using this asset, you will find $8,000 listed under accumulated depreciation, right? Because this is an account that measures how we have been using the asset. The wear and tear of the asset we estimate is $8,000. So that transaction will happen every single year for 5 years. So this readily is an example of straight line depreciation, spreading the cost along just the useful years. Okay, so what happens to this $8,000 is it goes under contra asset account. It also goes under depreciation expense account. Because remember, each and every entry affects these 2 accounts. So if it's a type of expense, later on it will be subtracted from revenue. Right? So just like other expenses. So this idea of depreciation, really we're trying to match up how we have been using plant asset and consider it as a way to support revenues generation as well. So expenses, all the other types, sales, general expenses, administrative expenses, just like those, we also estimate depreciation expenses and match it up against revenue. So this is the whole purpose of doing this, measuring that we have been using long-term asset.